All right. Let me share my screen. Okay. So see, our part two, we will be having, a whole part two divided into three main categories. One will be our basic information regarding the income, expenses, deductions, credits. So all these small topics, that is income and expenses, types of entity, okay, types of entities there. Then we have credits chapter, general business credits. So this all will be considered in one part. Okay. Second part is the type of entities in detail. So we have S corporation, we have C corporation, and partnership. Okay. Third one is specialized return. Specialized return means where it is not covered in our corporate or partnership return. One of them is trust taxation, estate, and farming income. Okay, so these are the three main categories which we are going to learn in our part 2. One more category is the last one is property transactions. Okay, where you will learn like kind exchange, when you purchase some asset, when you put it into the business use, there is a depreciations, what are the types of depreciation, all those things will be covered in the property transaction. So today, this time, from specifically from this batch, I am starting from the specialized return. Okay, because we already know what is the basics of the types of entity and all. Let's start with the specialized return today, and then we will move to the basics. Okay, this income and expense, types of entity, what are the general business credits, this all things we will take at the second place. Third thing we will complete is the property transaction, and at the very last we will see the different types of entities in detail. Okay, so what I'm planning is weekly plan I have. During this whole week, I'll complete the specialized return. Second week, I'll complete this. Third week, we will complete property transaction. And fourth week, okay, fourth week plus fifth week, okay, we will do this types of entities. So I can say that in next 5 week, in next 1.5 month, okay, I promised 45 days. So next 45 days, this is how we are going to follow the our learning pattern. Second thing is Monday to Friday, we will complete one topic, and on Saturday we will have a mock exams. Okay, that will be uploaded on our Google Classroom portal. This all lectures which are getting recorded will also be uploaded over there, so you can refer it while studying. Okay, it's in a non-downloadable form, but yes, you can refer it in number of times. Saturdays we will having a mock exam, and on Sunday you can ask me any doubts, queries. We will have a one-on-one doubt solving session. So this is how our whole study will be going on for the part 2 batch. If you're not getting the exam dates, that's fine, but be prepared. At least be prepared. Just target your next 45 days. Those who are from the previous batch, they might have completed few of the topics. I think that the last part, fourth part, C Corp, S Corp partnership, that is already done. Only your first part is remaining. Sorry, first part, that is specialized return, which we are going to start today, that you can easily complete. Property transaction is also done, okay, for the previous batch. Only this specialized return and the basic, like the small topics, income, expenses, credits chapter, those all topics are remaining. Okay, so don't worry, maybe you can assume that in next 2 weeks, each week we are taking one part. Part 2 is actually a lengthy and very much interesting topics we will have a lot of calculation, lot of practicals to understand. So there, just remember one thing, I am going to teach with a logic, a proper logic, which you will find easy to remember. Don't mug up anything. Okay, so let's start with the today's tax topic, that is specialized returns. In specialized return, those kind of incomes which are not reported on any other form, we will check is there any different form applicable. let's say if a person dies, okay, if a person died at the end of the year, you need to file a normal 1040 return. Okay, now let's assume if a person dies between January to March. Okay, so can I say previous year? What is our deadline? What is our due date to file a normal 1040 return? It is 15th of April, right? So at the time of filing the return for previous year, let's say this 2024. Okay, for previous year, Jan to December 2023, can I say the person was alive? Right, since the person was alive in this whole year, when you file a return on 15th April 2024, you will file a normal return, you will not file a final return. The person died somewhere in the month of February, Feb 24. Okay, so that doesn't mean that the next upcoming return you will file it as a final return. Final return will only be applicable in the year of death, when you're going to file this year's tax return in next year, right, till 15th April 2025. So on that date you will be filing the descendants final return. Now, what all things you need to remember? All these topics are interlinked, these three topics. Okay. When a person died, we are going to file a 1040 final return. Okay. After that, within next 9 months from the date of death, we need to report all the assets to the IRS. So just a one-time reporting needs to be done within 9 months from the date of death in the form of estate tax return. Okay, got it, guys? So for that, we will file a separate 709 return. Okay, just a minute. 990 descendant estate is 706. Okay. Yes, 706. 709 is for the gift tax. Okay. That one also will do indirectly, it is there in this. Okay, 706. So estate tax return you're going to file within 9 months of the date of death. Here you need to show all your assets to the IRS and pay a one-time tax on the estate tax liability. One-time tax, that is estate tax liability. Now, how you're going to pay this? The representative of a deceased person, they will have to decide whether you want to go for FMV on the date of death, or you want to go for a FMV on alternate valuation date, which is nothing but 6 months from the date of death. Okay, so either of them you are going to consider and compare it with the cost price of all the asset. Whatever is the difference between cost and FMV, that will be liable for estate tax. Okay, now you will say that the person might have purchased the asset 50 years ago, and after 50 years, when you see the FMV, it will be on a very higher side. So there will be that is unfair, right? That's why there is one more thing which is being provided by the IRS, one more benefit. If you have a lifetime exclusion balance still pending, what is lifetime exclusion? This is something which is applicable in gift tax. Whenever you gift something to any person, let's say your family, your friends, or any XYZ person, then you can easily deduct 17,000 as a annual exclusion from the gift. Means, let's say I gifted to my sister or $25,000 in cash. So up to 17,000, it is non-taxable. Above that, it will be taxable as a gift tax to me. I'm giving her as a gift. So the exclusion amount which I am taking, this will reduce my lifetime exclusion. Means during my life, I can have a 20,000 of exclusion for any gifts which I'm going to make. Okay, just a minute. Yeah. So please remember this thing. 20,000 is the lifetime exclusion which is allowed. Now, what the IRS says, when a person dies, whatever balance is outstanding on this account, okay, this, yes. Okay. Whenever we are going to make a payment of estate tax liability, whatever is the difference between FMV and cost, you will get one more benefit of reducing the balance from your lifetime exclusion account. Okay, clear guys, this much is clear. So on this amount you will be paying a estate tax. Okay, please understand here the flow of return, the flow of taxes and the credits. If it is clear, then the MCQ solving will be easy. Else you will get confused. What is 1040? What is 1041? What is 706? When it needs to be filed should be clear in your mind. Okay, and what all incomes should be included for your E exams, when it should be filed, what category of income will be included, what will be allowed, what will be disallowed in this return. Only this portion is important. Plus, in your whole E exams, the criterias, exceptions should be done very well. Limits and all is fine. That's they are not going to focus more on the limits and amounts and phase out limits. Okay, main thing is criterias, exceptions, and what form needs to be filed, what inclusions, exclusions will be there in the return. Okay, see, now here estate tax is okay with everyone, like everyone understood what is estate tax return. Like when we are going to file is after 9 months, what will be included, just the difference between FMV of all asset, whatever asset the deceased person was holding, take the FMV of all asset minus cost. That difference, that will be considered as a benefit, and that will be liable to estate tax. Okay, now just remember one thing. uh, from January till the date of death, okay, he was alive from the starting of the year till the date of death, the person is alive. So this income will be included in 1040 final return. Just like a normal 1040 return, when you file a 1040, you take all the expenses, all the income, schedule A deduction, credits, right? Everything will be exactly be same as per the 1040 instructions, 1040 law. Okay. After the date of death till December. Okay, let's say the date of death is June. Let's assume 30th of June. So here you have 6 months, and here you have 6 months, right? So this next 6 month, let's say the person was having a schedule C business, or the person is having a escort business, or any business. If he is going to have the earnings from that business, so any earnings after the date of death till the end of the year, this earnings will be called as IRD, income in respect of descendant. Okay, now you're going to file the return and include all the income till the date of death. What about after the date of death? What will happen for any income earned after the date of death? For that, you need to check this income is received by whom? Is it received by the beneficiary? Okay, beneficiary is receiving, then it will be included in their return. In their return, they have to include the income. Okay, now if the beneficiary is not receiving, but the estate is receiving. Estate means the person, the representative, the fiduciary, the trustee. Okay, these three words will be used. If they are receiving the income from any asset or earnings after the date of death, it should be included in that trust return. Trust return. See, estate return is not going to mention any income. Estate return is just representing the assets and the cost basis of a particular deceased person. If you have earned income on that, then you have to file a 1041 return separately. The deadline is the same from the end of the year. From the end of the year, you are going to file it on 15th of April. Okay, same way if the beneficiary is going to straight away receive, let's say the spouse is receiving the income in her bank account, so she will include it in her tax return. Okay, so here the date up to the date of death, 6 months is there, that all income will be included in the 1040 final return. After the date of death, whatever income you're going to earn, the deceased person is going to earn, that is income in respect of descendant. And this IRD income where we need to include will depend on two categories. One, who is receiving it straight away, the beneficiary is receiving it or the estate is receiving it. Okay, so if the beneficiary is straight away receiving it, include it in their income. If the estate is receiving it, you have to file the trust return 1041. Okay, that is on 15th April you need to file it. Clear, guys? This much is clear. Now, trust, regarding the trust income, see, trust can be formed because of a person is deceased or because of a person is alive. A living trust is also there, and a person who is deceased, after that the trust can be formed. Okay, so let's see one by one. We have seen the clearly the meaning of deceased final tax return, estate tax return, and trust information, right? Any question in this three terminologies? We have just understood the terminologies yet. Any question, guys? Anyone?
Can you please explain estate tax return?
Yeah. Estate is when a person dies, just after 9 months, you have to file the estate. What information will be provided in estate? What all assets? What all liabilities? Like assets and liabilities information will be provided in the estate tax return. And based on the difference of FMB and cost, you are going to pay a one-time tax, or that is estate tax. Okay, whatever is the asset which a person might have owner when he was alive, now at the time of death, whatever is the FMB on the date of death, or the alternate valuation date, this who will select whether to select date of that FMB or alternate valuation date? The representative who is going to file the estate tax return, and they will select it only if it gives a tax benefit, not to increase the taxes. Okay, clear? Now, one more thing. Let's say the alternate valuation date is 15th of October, and date of death is 6 months before the 15th October. That is uh, 15th April, right? So within this between these two dates, if the asset is transferred to the beneficiary, it happens, right? It is mentioned in the will that way, who should receive the asset and all. So on the date of transfer, whatever is the FMV, use that date while filing the estate tax return. Use that value on the date of transfer. Use the FMV if you are electing the AVD, alternate valuation date. Got it, everyone? Saumil, got it, this part?
Yes, sir.
Okay. So this is what is estate. Descendant is when the person dies. Estate after the date of death. Within 9 months, you have to file it just to show the asset value to the IRS and pay the tax on assets FMV minus cost. And if that asset is generating income, let's say it's a rental property. So if the rental property is generating income, you will be filing a trust tax return 1041 to mention all the incomes, expenses on that particular asset. Okay, so let's start with one by one. I'll come to this two exempt organization also later on. First, let's start with the descendant final income tax return. The due date of this is 15th April. Final return. Okay, if death occurred between Jan to April, okay, this is just an example, between Jan to April 2022. So due date will be 15th April 22. Final return due date will be next year, because here you will file a normal return. The person was alive in 2021, right? And you are just filing a normal return. Due date will be 15th April 2022. Now the person died between this 2 month, we will be filing the final tax return in the next year's due date, that is 15th April 23. Okay, now if a person is married, at the time of death, the descendant and the surviving spouse are considered married for the whole year. Got it, guys? So if a descendant is married, say in this year, in this year, the person died, but before that he was married. So while filing, he will be filing a MFJ only. The spouse will be filing a MFJ with the deceased spouse. Okay. Then what all incomes to be included? Yes. Now this is the main calculation scenario. If a person is going to use a cash method, or if a person is going to use the accrual method, based on the methods you need to consider the incomes and deductions into your 1040 final return. This we are learning right now, descendant final income tax return. Okay. So see, income to be included in case of cash method, if you're receiving the income from coupon or bond, if coupon is matured in descendant's final tax year but had not been cash. Okay. If it is matured but the cash has not yet received, so it will be considered as a constructive receipt. Please understand what is constructive receipt. For example, I gave a check to Mr. X, okay, with today's date. So he has received the right to encash that today only. Now let's say after 1 month the person died, but check is still not encashed. So that check value, the amount mentioned on the check, will be considered as a income in his 1040 final return. It will not be considered as a IRD. Please understand this thing. In it, for exam purpose, they will ask a lot of questions on what portion will be added in the 1040 descendant return and what will be the IRD. IRD means income in respect of descendant. Any income when a person receives after the date of death is IRD income. IRD income in respect of descendant. Okay. So if a person is using a cash method, everyone knows the meaning of cash, right? Cash method. Till the date of death, if the person is receiving cash, so that all is included in his income. Whether the services are accrued or not, that doesn't matter. But as soon as the person receives the cash, it will be included in his income. Okay, got it, guys? So this is the one scenario. Second scenario is accrual method. So when the services are provided or the goods are sold, straight away included in the gross receipt. Now, if the cash is received after the date of that, it doesn't matters, because since in accrual method we are adding it on the date of accruing the income. Got it? So let's say rental income was about to receive. Now rent income has been accrued, the tenant has not yet paid. After the death, he's paying the rent for the 2 month. This 2 month rent is already included in the 1040 descendant return. Why we will include it? If the person is using the accrual method. Okay. I hope everyone is aware about the meaning of accrual and cash method. Right? Any question? Anyone? Yes, Karan.
Yeah, I see.
Yeah.
So like instead of descendant, isn't should it should be deceased here?
Sorry, instead of
Descendant word, it shouldn't it be deceased?
income in respect of diseased. Yes, I use the word disease only.
Like everywhere here it is written descendant instead of deceased.
Descendant estate, if estate receives. No, it is disease. It should be diseased only. You are correct. It should be diseased only. The person who died. So for that, and descendant means like their representative, their family members. Those are descendants. Okay, it is diseased only.
Okay.
Descendant. Okay, by mistake, the deceased descendant. No, it's descendant only. Wait, just a minute. Huh? Okay, it should be diseased only, huh, guys? The whole words are been misplaced instead of diseased. Everywhere descendant has been placed. So wherever I'm using the word, please focus on that, not on the wordings. Okay, not on the wordings mentioned over here. So it should be diseased when a person dies. For him, what all things will be included in his 1040 final return will be based on two things. One is cash, based on the cash method, or second is based on the accrual method. Okay. Now, please remember one more thing is declared and received dividend. When the dividend is declared and before it is received, just between this two date the death occurs. So we are not going to include it just on the basis of declaration if you are using the cash method, unless we actually receive it in the mail means check, or actual receipt of amount in the bank account. We cannot include it if you are using a cash method. Okay. Now, income in respect of deceased, what all things we are going to include? If capital assets, okay, they will receive a step up means FMV minus cost, that is called as a step up. Any other assets, so one example is traditional IRA, it will straight away get transferred to the beneficiaries, or it will straight away get transferred to the spouse. Okay. And they will be responsible for paying the income tax if any other asset they are receiving. Let's say they are receiving some fixed deposit amount, current deposit. So any asset which is other than capital asset, they will be liable for paying the tax for including in their own return. Okay, beneficiaries. So all income that is not included in the uh final return of disease will be considered as a income in respect of descendant. Descendant or is a diseased only. Okay, it's a diseased, the person who died is a diseased. IRD is the income in respect of him, but we are receiving after the date of death. Okay. So IRD is included in the income of descendants estate if estates receive its deceased estate. The beneficiary, if right is passed, okay, 3% can receive the income, and it totally depends who is receiving the income, who is receiving the asset. In his or her tax return, it should be included. Okay. Next one is executor will be filing a form 706 estate tax return, will be filed by that person, because he will not be responsible to filing directly. Let's say the spouse or the beneficiary can be executor. If no one is ready to be an executor, the government will appoint an executor for his estate, and he will responsible for filing this form. Okay, got it, guys? Next one is, now what all deductions that person can get: medical expense deduction, loss deductions, and what all credits will be allowed. See, credits things will be just like a nominal credits, just like in 1040 return we receive a credits. Same way for that individual final return, he will receive all the credits as it is. Let's say he's eligible for child tax credits or child and dependent care, so he will be allowed to take all the credits which is allowed on the normal return. Now, loss deductions, whatever carry forwarded losses will be there, that will not be carry forward to the estate tax return. On 1040 final return, yes, you can take all the losses which are allowed up to the limits, up to the certain limits, right? For loss limitations, we have certain limits given by the IRS. If active loss is there, it will settle off against active. Passive loss will set off against passive only. But apart from that, if we have a short term, long term capital gain, capital loss, in case of short term capital loss, any excess loss, $3,000 can offset against the ordinary income. Anything which is still remaining, which cannot be carried forward to the estate tax return or the trust tax return. Please remember this thing. Okay. Or it cannot be transferred to the beneficiaries also. The one more important part is medical expense. Now, if person died, just before that, let's say they have incurred a lot of medical expense, right? For the health care and for hospital, bed, everything. When a person is paying this medical expense out of his pocket, up to that much amount he can take as a deduction, schedule A deduction on his 1040 final return. Now, let's say there are still some expenses which are outstanding to be paid to the hospitals yet to be paid for medical expenses. Okay, so what will happen is the estate has the option to pay these expenses within 1 year. So if estate pays the medical expense during 1 year, like out of his asset, if it is being paid after the date of death within next 1 year, you can take the whole medical expense even paid after the date of death in the schedule A 1040 final return. Now you will think that if, let's say, on due date we file the return, we have taken only the expenses incurred before the date of death. You can again amend the return and take the extra expenses which you might have forgotten to taken, or due to this limitation now it is allowed. You can amend it, mention the reason for amendment, and take the extra deduction, itemized deduction on the return. And whatever taxes you might have paid, you can get a refund of it. Okay. Now, what is the liability of the estate? Like, if not paid before death, it will be liability of estate, right? So it will appear on Form 706 if it is not paid within 1 year. So executor may elect to treat all part of expenses paid by descendant rather than on 706. Means if the disease is going to pay it, okay, that's fine. If the estate is going to pay it within 1 year, it will be considered in his 1040 return. If estate is not paying within 1 year, it will be an outstanding liability on the estate tax return. And as and when the estate will pay, estate will take the deduction on that. Got it, everyone? So estate tax return is clear for everyone. Let's read the deadline, the filing, and the other compliances which are required for the estate tax return. See, 1041 will be filed after you file 1040, just to mention the income. Estate return will be filed just to mention the distribution of the assets to the beneficiary, or to mention the step-up basis to the IRS. Okay, so when the person dies, a probate proceedings will open depending on the state law. Every state has a different law, so proceedings will start. Now, within 30 or 90 days from the date of death, if there has to be first action, what will be the first action? To appoint the representative. Okay, so it can be any of the family member or any beneficiaries can be appointed. Now, let's say if there is no executor or administrator appointed, qualified and acting within the states, anyone who is possessing the property will be the qualified executor for that particular asset. Let's say rental property is there. The person who dies, he doesn't have any family member or anything. The person who is living there as a tenant, that person will become a representative for that particular asset. Let's say the same way there are 5-6 rental properties, all the tenants will be responsible for their assets, like for the rental property in which they are living. Then the state law, the when the probate will start, they will mutually decide who will be considered as a representative for filing the estate tax return. Within next 30 to 90 days, it will be decided. Got it? Next is primary duty of personal representative. What will be his duty? His duty will be first to apply for EIN, because when you file a estate tax return or you file a 1041 return, you will need a EIN number. All the corporate returns, okay, they require a EIN number. So apply for the EIN if estate is required to file the return. Then file all the tax return when due and pay the tax required up to the due date of discharge from duties. From where they will pay the taxes? They are not going to pay. Representative will not pay the taxes out of the pocket. After they segregate the assets to the beneficiaries, or wherever it is required, they will recover some money from that to pay the taxes. Okay, now let's say estate paid the tax on property A. Now this property is transferred to the beneficiary. When the beneficiary receives it, this beneficiary will take a credit of all the taxes paid on this property A to the IRS. Clear, guys? What are the filing requirements? Personal return, personal income tax return also they will have to file, and estate tax return also they will have to file. Let's say there's the spouse is not a representative, no one is there, so the representative appointed by the state law will be also liable to file the personal income tax return. right? Along with this, if the asset has generated some income, then you have to also file a 1041 return. So if asset generates the income of more than $600, he will be liable to file the return. If any non-residence is there, then there is no limit. Even if you generate an income of $1, you have to file it. There is no limit. But if a resident person died and his asset generated some income, he will have to file the return if more than $600 income is there. Okay, so what are the 2023 tax rates? If your taxable income is up to $2,900, okay, taxable income means when you add up all your incomes minus deductions. Deductions should not be the personal expenses. Okay, we will see the definition of incomes and deductions later on. So please make sure to check the taxable income. In this particular chapter, I would request to remember the tax rates and the slab rates only for this estate return. Okay, wherever in our whole syllabus, wherever it is required to remember the limits, I'll mention you. Wherever it is not required, I'll also mention you that no need to remember the limits. Here $2,900, 10% tax rate will apply. 2,900 to 10,550, 290 plus 24%, 10,550 to 14,450, 35%, and more than 14,550, 37% will apply. Okay, so please make sure like how the calculation is done. Whatever is your upper limit minus lower limit, okay, multiply by the current slab's tax rate, that much you have to take, plus whatever is your previous tax percentage tax liability is coming, that is 2,900 into 10% straight away. It's simple calculation. That the same thing which we do in Indian taxation is the same calculation of considering the estate tax. Okay, now what are the exemptions and deductions on form 1041? Estate is allowed an exemption of $600, only that standard deduction, just like in normal 1040 return we have standard deduction. Same way here you can get a $600 of exemption. No exempt for dependent. There is nothing like dependent credits or anything will not be allowed on estate tax return or 1041 return. Straight away a standard deduction 600 will be allowed. Okay, now next is charitable contribution. Let's say a representative is making a charitable contribution out of his estate return. Will that be allowed? The answer is yes, only if two conditions are satisfied. Allowed only if specifically provided in the will. Okay, straight away no one can just do a charitable contribution from their asset, right? If they don't want to do any charity, then the estate representative cannot go for it. If it is mentioned in the will that after my death I would like to give a $10,000 into XYZ as a charity, so it should be mentioned in the will, plus it should be paid out of the gross income of the estate. Okay, for whatever gross income is being generated on the asset, out of that it is paid, or it is already permanently set aside, just like a qualified charitable organization. Okay, in IRA topic, those who have already done part 1, there is one topic which is straight away you can contribute from your IRA account into charitable organization. So same way, if it is permanently set aside from your IRA account, it was permanently set aside for making the charity contribution, or if it is paid out of the gross income of the estate, plus it should be mentioned in the will, then you can go for a charitable contribution. Okay, qualified conservation easement grant are not allowed after the date of death and before the estate tax return. So these are the grants. If let's say you want to give the grants based on some, let's say for education, for health related, so that are qualified conservation grants, those are not allowed, even if it is mentioned in the will. Okay, after the date of death and before the estate, means within next 9 months from the date of death, you cannot give a grant to someone. Okay, but yes, if it is written in the charity that you in the will, it is written that you want to give it to the charity, then it is allowed. Grant means, I hope everyone knows now, like it's a kind of a money which you are providing, a concessional rate of loan, I can say, which you are providing. It's a grant, just like government subsidies are there. Same way you are providing some grant to XYZ person for some specified purpose, let's say for education grant, some health related grant, for some construction of a particular public related property. So this all things are, the grants are not allowed, but yeah, charity will be allowed. Second one is losses. Estate can claim the deductions on sales of property. Whenever you're going to sell a property, okay, so they can claim a deduction for sales of property if there is a loss. Okay, it can happen that, let's say it's a depreciable vehicle, depreciable asset, sorry. So when you purchase that vehicle, it was for 10 lakh, but now when you're selling it in the market, the value has been reduced to 5. So the loss will be allowed on estate tax return if you're going to sell it in the market. Estate and beneficiaries are considered related for the purpose of loss on sales of property. So in case of related party transaction, what is the scenario actually? When you're going to sell something to the beneficiary at a low price, right? So that estate cannot record the loss based on the related party rule. What is the related party rule? When you sell something to your related party, the losses will be disallowed right now. But later on, when this related party sells it to the third party, some unrelated person, and have a gain, then previously disallowed losses will be allowed to set off against this gain. Got it? Any question on the losses side? So if you're going to file a 1041 return, first exemption you will receive straight away for 600. Charitable contribution will only be allowed if you are, if it is mentioned in the will. And third, the losses will be allowed only if you are selling the asset. And third, the losses will not be allowed if it's a related party transaction. Okay. Next is casualty and theft loss. Yes, this is a common transaction. This can be allowed to estate also if they are filing the return. And if in the 1040 final return, this casualty theft loss is not recovered or not taken as a deduction, it can be taken on the estate return. Next is administrative expenses. Now, all the expenses, all the admin expenses can be deducted either from the gross estate for figuring the exact amount of tax to be paid. Okay. Now, what are the administrative expenses? All the court and legal cases. For that, you have to pay some paperwork you have to do. For that, you need to pay some legal expenses. That will be allowed. Funeral expenses will be allowed. Okay. So any expenses which are related to the admin part of filing the 1041 or filing the estate return, or transferring the assets to the beneficiary. So all these are legal expenses, admin expenses will be allowed when you prepare a estate return. Okay. Next is depreciation or depletion. So a portion allowable depreciation and deduction that accrue after the date of death between estate and beneficiary based on income of estate that is allocable to each beneficiary. So just remember, let's say the asset was in the name of estate for first 3 months, Jan, Feb, March. Okay. After that, from April to December, it got transferred to the beneficiary. So estate will claim, let's say that the asset is a capital asset, it's used in the business. So the estate is going to claim the depreciation for the first 3 months, and next from April to December, beneficiary will claim. Beneficiary cannot claim the depreciation for this first 3 months. He can claim for only from the date when he got the possession, he got the ownership. Okay, clear guys? Any question till now? Okay, now let's see, this estate is now going to distribute their asset. So limited to distributable net income. Okay, and they will have to pay estimated tax also, just like a normal income generation. When you pay your estimated tax, if you're an individual 1040 filer, same way for your estate return, for a 1041 return, if the asset are going to generate income, you have to straight away pay the estimated tax. Okay, so tax year, either a calendar year or a fiscal year, you can pay the estimated tax till the due date, that is 15th April. And specifically for trust returns, the extended due date will be from date of filing the original return. 5.5 month is allowed. So if the tax year ends before 2 years after the date of death, means 1041, what is the purpose of 1041? All the asset which is still not distributed, still not bifurcated to beneficiary, and income is still getting generated on this, you are going to file each year 1041. Now let's say within next 2 years the assets are distributed. Okay, and within next 2 years the 1041 is closed, like no need to file 1041 because all assets are now distributed to the beneficiary. Okay, so if the tax year is ending more than 2 years after the date of death, whatever is your date of death, okay, date of death, after that 2 years straight away you are filing the 1041 return. If yes, more than 2 years, then follow individual estimated tax deadline, that is 15th April, 15th September, 15th Jan, 15th June. So these are the estimated tax deadline you need to follow. But let's say you are going to like with for the first 2 years, no need to follow the estimated taxes. After 2 years it will start. Okay, so let's say within 2 years your account is closed, means your whole assets are distributed and there is no income generation on the estate side. So just a single full payment will be done when you file the return. As and when you file the return, pay the taxes on that. No need to go for estimated tax. Got it, guys? Any question till now for estimated tax? Anyone? Okay. Now next one is distributions to the beneficiaries from the estate. Now beneficiaries of the estate that must distribute all of his income correctly. This happens in simple trust. Simple trust, you will see the types of trust. Simple trust, and second one is that those are not required to distribute the whole income. This is the complex trust. Okay, see, if the whole terminology and chart is clear in your mind, understanding this topic will be easy. Else if you don't know from where the income is flowing, from like when it will be included in the which tax return, then everything will be difficult to understand. So please remember, once now all the assets are entered in estate, okay, you are still paying after 9 months you are going to pay your taxes on your income generation on that asset in the form of trust. Okay, trust return. So if that trust is required to distribute all his income earning, that kind of trust is simple trust, and the another is a complex trust. Okay, so see, they will report their share of distributable net income whether or not they actually receive it. So the beneficiary, if they are a part of a simple trust, they will receive a 1041K1. Okay, I hope those who have already done a little bit portion of part 2, they remember what is K1. K1 is a pass-through entity income information given to their members, to their shareholders, to their partners. Why? Because in our whole part 2 topic, escort, partnership, 1041, these three are your pass-through entities. Means when you file this 1041, when you file a 1065, when you file escort, the corporation is not going to pay any taxes, but their beneficiaries, shareholders, or the members or the partners, they will be paying the taxes. So how they will know what is their portion of tax? They will receive an individual K1 which will mention the income and expenses, and every small details will be mentioned in that, which they need to make it taxable in their return. So they will report their share through K1 of all the distributable net income. Whether or not they actually receive it in the bank account or not, they will have to pay the taxes. Okay. Now in complex, what will happen? They don't have to distribute the whole income in the same year in which they earn. So they will report all income that must be distributed to them, whether or not actually distributed, plus any other amount credited or required to be distributed up to the share of DNI. So once we do the steps, okay, once we look at this example, this steps, step 1, step 2, step 3 and 4. There you will understand what is DNI and how much of this we are going to allocate. I have given one example on simple trust, and we'll take one example on the complex trust, okay, to just understand the calculation part. In this chapter, yes, calculation part can come in exam, and the basic limits, terminologies can be asked indirectly in the question. So just think the whole topic in a logical manner, and in a very systematical manner. Don't mug up the things. Okay. So these are the two things which we will be understanding through example. Next one is request for prompt assessment of tax. So if someone doesn't want to wait for 9 months, see what is the assessment period. Actually, the assessment period will be 3 years. Okay, so if you have already filed your estate tax return, final descendant return, and you already filed your 1041 return within 1 year and closed all the assets, you should ask for the early assessment of your tax return. So personal representative, they request for prompt assessment. As soon as you file the return, do the assessment, and complete the assessment over there only. Do not wait for your statutory time limit, whatever is the statutory time limit. So settlement of tax liability of estate, earlier ASEO, that is nothing but your statutory time limit. You can go for 18 months from the date when return request was received. When you write, representative will write a letter to the IRS. So from that date, within 18 months, you can go for prompt assessment. Within next 18 months, anytime your return can be opened for the assessment, and there can be changes which can come in your return within next 18 months. Okay, so this is all about our theory portion of the trust. Tomorrow when we'll start with one of the sum of the trust topic, where we'll understand the types of trust, grantor, simple and complex trust, what are the calculation part in these three topics, these three types of trust. Okay, and then farmers also we are going to, like, as I mentioned, I'm going to take all the specialized returns together. Okay, for detailed understanding of topics, will there be some? Yes, there will be detailed notes, not claim notes. We will be using our own notes. Wait, let me show that. To yes, so this is just an example copy of our book, which will be not a Gleam book, but we have made a very easy language book, because Gleam book is like a trust portion. No, we don't provide soft copy for any topic. Okay, once you enroll, you will get straight away the hard copy of the books. The thing is, there is an issue with the easily sharing of the notes on the Telegram. Even if I talk about summary book or a regular book, nothing will be shared in the soft copy, not even a single chapter. Okay, so sorry for that. We have also studied, right? Before 2 years I was also studying EA, like before 3-4 years. So I know how we used to get the notes from Telegram channels, from WhatsApp channels, from groups. So that is the reason, to restrict that thing, we don't share any of the soft copies. Right. So all right. Second thing is, we are going to provide you this notes. Currently it's available if you want to buy only notes, only the summary notes, and if you have already done the classes from somewhere else and you want to just go through the easy language notes plus summary notes and watch the summary revision lectures, which will be anyways be uploaded on YouTube. So that is one option. Or else, if you think you want a detailed knowledge on each and every topic with examples, MCQ access also will give, as I mentioned in the starting of the class, Monday to Friday will complete the topics, and on Saturday there will be a mock exam, on Sunday there will be a doubt solving. Also, after we complete the whole batch, there will be a one-on-one revision sessions, doubt solving sessions, exam tips and tricks, which will be given just before your exams. So yesterday only we had, for part one, we had the batch from 4 p.m. to I think 9 p.m. with some 15 minutes of break, and we completed the whole topic revision along with IMP topics. Okay, so same thing we'll have for the part 2 and part 3. So still wait for next 2 days. 3 days demo is free. Once you decide to enroll, you can just let me know. And part 3 demo is today evening 6 p.m. So make sure to join that, those who want to attend the part 3 also together. Okay. All right then. Thank you guys. We'll meet again tomorrow same time 9:15, and we'll complete the trust topic from the detail book. Okay, we'll complete it from the detail book so you can get an idea about how a detail book is there. Okay. Thank you. Have a good day. Bye.